Right now, as you're watching this, trillions of dollars are moving around the planet, not through banks, not through stock markets, not through crypto. They're flowing through quiet pipes most people don't even know exist. No apps, no headlines, no notifications. Just a small group of invisible middlemen deciding who gets money, when, and at what price. You don't vote for them. You never see them. But your mortgage, your job, your savings, even grocery prices depend on what they do next. And if they ever stopped, the global economy would freeze in hours. Let me show you who they are. Imagine this. It's 2008. Banks are collapsing. ATMs are being rationed. Markets are falling so fast that traders literally walk away from their desks. But behind the scenes, something even scarier is happening. Major financial institutions can't lend to each other overnight. Not because they don't want to, because they don't trust each other anymore. And when that trust disappears, the entire system starts to seize up. This wasn't about stocks. This was about plumbing, the hidden plumbing of money. That's where our story really begins. Most people think money moves like this. You deposit cash. The bank lends it out. Someone buys something. End of story. Clean. Simple. That story is about 30% true. The other 70% lives in a shadow world called the wholesale money market. This is where banks, hedge funds, pension funds, insurers, and governments move gigantic sums of money back and forth, usually overnight, using collateral instead of trust. And sitting in the middle of all this, a small class of institutions called clearinghouses, prime brokers, repo dealers, and settlement agents. They don't take deposits. They don't offer credit cards. They don't advertise on billboards. But they quietly intermediate tens of trillions of dollars every single day. Let's zoom in. Start with something called repo, short for repurchase agreement. Here's the simple version. One institution needs cash for a day. Another institution has extra cash, so they make a deal. I give you bonds today. You give me cash today. Tomorrow, we reverse the trade, plus a tiny fee. That's it. It sounds boring. It's not. This market moves over $4 trillion a day in the US alone. Over $10 trillion globally. It's how banks fund themselves. It's how hedge funds leverage bets. It's how governments stabilize liquidity. And every single repo transaction flows through a small group of intermediaries. They handle collateral. They manage margin. They guarantee settlement. They decide what assets are acceptable. They decide how much haircut you take. They decide who trades and who doesn't. No drama, just rules. And rules create power. Now, picture this. You're a massive hedge fund. You want to borrow $10 billion overnight. You don't call a random bank. You go through a prime broker, usually one of the same 5 global giants. They sit between you and the rest of the financial world. They arrange funding. They rehypothecate your collateral. They bundle your risk with other clients. They route everything through clearing systems. They see everyone's positions. They know who's over-leveraged. They know who's desperate for liquidity. They don't just move money. They see the entire battlefield. That information advantage is priceless. Then there are clearinghouses. These are the quiet referees of global finance. Every time stocks, bonds, or derivatives trade, a clearinghouse steps in and says, if one side fails, we guarantee the other. Sounds helpful. It is. But here's the twist. To protect themselves, clearinghouses demand margin, sometimes suddenly, sometimes aggressively. When volatility rises, they raise requirements, which forces participants to dump assets to raise cash, which pushes prices down, which increases volatility, which leads to even higher margin. It's a feedback loop. The middleman doesn't cause the crash, but they can accelerate it, just by following their own risk models. Now, let's talk scale. A handful of institutions clear most of the world's trades. A handful of dealers dominate repo. A handful of custodians safeguard the majority of global securities. We're talking about infrastructure so concentrated that if even one major node fails, markets don't wobble. They lock up. In 2020, when COVID hit, U.S. Treasury markets, the safest market on Earth, stopped functioning properly. Not because people didn't want treasuries, because the middlemen couldn't absorb the flow. The Federal Reserve had to step in and buy over $1 trillion of assets in days, not to stimulate growth, to keep pipes from bursting. That's how fragile the system really is. Intermediaries handle exposures measured in hundreds of trillions, but they operate on thin capital buffers. They rely on confidence, on models, on the assumption that tomorrow will behave like yesterday. When everything works, they look invisible. When something breaks, they become the single point of failure. And here's the irony. They exist to reduce risk, yet their centralization concentrates risk. They simplify markets, but complexity piles up behind the curtain. They promise stability, but stability depends on their uninterrupted operation. It's like building the world's economy on a few extremely efficient bridges. Amazing for traffic, terrifying during earthquakes. Now, let's bring this closer to home. You don't trade repos, you don't post margin, you don't clear derivatives. But these systems quietly decide how expensive mortgages become, whether pensions stay solvent, how fast governments can borrow, how quickly companies can make payroll during crises. Every interest rate you see starts in these markets. Every financial panic begins here. And when stress hits, the costs flow outward, to workers, consumers, taxpayers, never to the plumbing. There's also a strange cultural blind spot. Tech CEOs are famous. Hedge fund managers make headlines. Crypto founders become celebrities. But the people running settlement systems, the executives overseeing collateral flows, the architects of margin models, you've never heard their names. They don't want fame. They want stability. But anonymity also means accountability is fuzzy. These institutions aren't fully public. They're not fully private. They're too important to fail, but too technical for political debate. So they quietly grow more central every year. Now, let's talk about hype versus reality. People argue endlessly about cryptocurrencies replacing banks, about decentralized finance, about programmable money. But none of that touches the real choke points. You can build all the apps you want. At the end of the day, assets still clear through centralized nodes. Collateral still flows through custodians. Liquidity still depends on a small dealer network. The future gets marketed as decentralized. The present remains tightly centralized, and that gap is widening. Zoom out. Global debt is at record highs. Governments depend on constant refinancing. Corporations roll over trillions in short-term funding. Markets move faster. Leverage is easier. Stress travels at internet speed. Which means these middlemen are now more important than ever. They're not villains. They're engineers of financial gravity. But gravity doesn't care about intentions, only mass. And the mass is enormous. So here's the quiet truth. The world doesn't run on money, it runs on settlement, on collateral, on overnight promises that everyone assumes will be honored in the morning. A few invisible institutions keep that promise alive. Every day, without applause, until one day they can't. And then everyone suddenly learns their names. We like to believe economic power lives in governments, billionaires, or central banks. But much of it lives in the boring middle, in clearing rules, in margin calls, in balance sheets that never make the news. And that raises an uncomfortable question. If the real power of the global economy sits inside systems most people don't understand, who's actually in control, and what happens the next time trust disappears overnight?